right, lesson 2, stocks, bonds, and indexes. So I have a disclaimer. So this lesson is designed for the basics of stocks, bonds, and indexes, and we're going to dive into the origins and meaning for today's investor. And it is for those who don't really know that much about what makes up the stock market, also known as equities, and bonds, about fixed income. So if wanting to skip to the Husky games, then you can jump to the 20-minute mark or so. So here's a recap from the previous lesson. We learned about 3 common indexes. S&P 500, the Dow Jones, and the Nasdaq composite are usually seen on financial news. They're used to reflect the health of the U.S. economy. They can also be purchased in individual and retirement accounts in the form of index funds, mutual funds, and ETFs. And just showing their logos. And to add a little more confusion, though, we have our S&P, Dow Jones, Nasdaq. The big 3 are the most common. There are currently over 9,000 funds to choose from. So there's a few examples. We can buy funds that reflect small U.S. companies called the Russell 2000. There's mid-sized U.S. companies that's reflected by the S&P 400. Or there's more concentrated large U.S. companies called the NASDAQ 100. So with 9,000 funds, we can have nearly every combination we could imagine. But overall, we'll stick to the big 3, the S&P 500, Dow Jones, and NASDAQ. And they are most commonly referred to as a reflection of U.S. economic health. We also covered stocks and bonds. So just a quick overview. Stocks will usually be more volatile than bonds. There's more ups and downs. And because of more volatility, as investors, we do demand a better return. And because most bonds are fixed, they are non-volatile and we expect a lower yield, but hope to at least meet inflation. There's our stock versus bonds. So currently inflation is at 3.0%. The current government bond rate is 4.1%, which is beating inflation by 1% or so. But the S&P 500 index is currently 17.8% total return. That includes dividends, and that's nearly 6 times inflation, and that's of December 2025. So since stocks tend to pay a lot better, obviously, than bonds, we have to deal with volatility, and the question is, why are stocks so volatile? So in the previous lesson, we did learn about companies will issue stock shares to raise money, and that's usually for their infrastructure improvements and expansion. But another reason is that the company now will be in the public eye, thus the name going public, and they need to show profitability. And when you show profitability, that drives the stock price up, usually, as more investors want in on the action. And that also helps to improve every other shareholder. So essentially it is a way to accumulate wealth so that at some point we can retire or some other financial goal. And that basically all equates to financial freedom. But the opposite can happen too. If the company is not profitable or not showing as much profit as had been anticipated, then the share price will usually go down. Other factors can drive the price down, like bad news. There's a lawsuit, poor leadership, or people start to just not like them for some reason. So there's a decrease in sentiment and so on. So in fact, we can peruse the news and find a lot more negative reasons than positive ones that can affect share price. So here's an aside about stock prices. So throughout these lessons, certainly in the games, we will refer to things being a bull and a bear. And this is in reference to the overall market, but it also can be used to describe company stock prices as well. So public companies are required to release financial data every quarter and an annual statement. And we'll get into more financial statements in future lessons. But for now, we need to know that investors and especially professionals will pay close attention to a company's quarterly results. So bull versus bear. So if pleased with the financials, meaning the public or professionals, then usually the stock price should reflect a trend that goes up, called the bull. The name is due to how a bull strikes with its head low as it charges until its arrival where it strikes up with its horns. And then if investors are not pleased with the financials, then the stock price will usually trend down, called a bear. The name is due to how a bear will stand on its hind legs until it strikes down with its two front paws. So bear or bull, and that means up for the bull, down for the bear. So features of a stock. So we will also refer to a stock as an equity. And equity simply means that it's fractional ownership. So it is a claim on a company's assets or earnings. And because we are owners, we can demand accountability from the board of directors. We also own even fewer shares, though, when we purchase an index fund, because that is a basket of stocks in one fund. But we're also considered partial owners also. So one, we have company ownership, as we just discussed. And though small for most of us, we will still get the vote on certain proposals made by the board of directors. Two, stock shares will go up, down, or sometimes stay flat, and that should reflect the health of the company, similar to how an index like the S&P 500 reflects the health of the economy. And three, investors demand a better return versus a bond because when a company is profitable, the stock price should go up. Unfortunately, if a company does not meet expectations for a quarter or for a year, then the price will usually go down. So now we'll cover features of a bond. So a bond comes in a few different types, but is generally known as fixed income. This is because it is a loan to a government or corporation that promises to pay the investor on a schedule, generally semi-annually every 6 months. Government bonds are very common, and they could be purchased as treasury bills that are short-term, about a year, and treasury notes that are set up for 2 to 10 years, and then treasury bonds themselves that last for 10 plus years. So first feature, bonds are a loan and must be paid back to the investor. There is a caveat that some corporate bonds pay a higher yield, but they can be risky, and those are known as junk bonds. Two, government and some municipal city bonds are usually quite stable since they bring in taxpayer money. Because of this stability, they generally pay a lower yield versus a junk bond, and certainly less than the stock market average. And three, bonds pay on a schedule. This is known as a coupon or interest paid. And when the bond reaches its agreed expiration date, then the balance is paid back to the investor along with any accrued interest. And because it is predictable, it is known as fixed income. All right, now we'll move on into the S&P 500. So S&P stands for Standard & Poor's. A little background, it comes from a 1941 merger of Poor's Publishing, founded by Henry Poor in 1860, that covered railroad data. And then Standard Statistics Bureau was established in 1906, so somewhat later, but that provided financial info and ratings. And Standard & Poor's logo. So as indicated in the name, it represents 500 companies that reflect the health of the U.S. economy. It's actually a little more than that as far as company amount, or at least ticker amount, because some companies have various share types. Sometimes there are A and C shares, where A gives for voting rights and C has no voting rights whatsoever. And we'll cover in later lessons, but this is simply to give us an idea. So here's the rules to get into the S&P 500 and stay in the S&P 500. So it has to be a U.S. public corporation issuing common stock shares on a U.S. exchange. It must have a market cap of 20.5 billion or greater as of January 2025. We'll get in a little more into what market cap means in the next couple slides. And it must have minimum trading liquidity and also trading volume. So liquidity means how quickly and easily you can sell an asset without much impact on its price. And volume is how frequently shares change hands, which can be a function of earnings or news. So basically, all of that means the stock just can't sit there and never get purchased or sold. So It needs to show some activity. Otherwise, it'll get dumped from the S&P 500. And here are some S&P 500 companies, a partial list, since there's 500 of them. I can't list all of them here, but these are the ones that have the most weight to the index. So you can see from the left top, we have NVIDIA, Apple, Microsoft, and Amazon. I also wanted to point out there's Alphabet, also known as Google, and you'll see that there are Class A shares, as I discussed in the previous slide. And then if you go past Broadcom, we get to Alphabet Class C shares. And you can see that they have a slightly different symbol for the Google. And they have around the same type of weight. But I just wanted to point out that this is why S&P 500 has 500 companies, but the actual tickers could be more than that. In some cases, you might have several companies having A and C shares. And as discussed, the A means they have voting rights, C, no voting rights. And they might account to, say, 510, 500 and whatever, 15, possibly different types of tickers, but they may belong to, like two of these might belong to the same company. And they might also have Class B shares, but I didn't have an example for that. But just to give you an idea that you have more than one ticker that represents basically the same company. All right, now we'll go into the Dow Jones. So DJIA means Dow Jones Industrial Average. It was created by journalists Charles Dow and Edward Jones to serve as a simple benchmark for the health of the U.S. economy. It was first published in 1896 and expanded to 30 stocks in 1928. And the number 30 is still maintained today. So it is a reflection of large blue chip U.S. companies. So how the Dow Jones determines its company weighting is different compared to the S&P 500 and Nasdaq. It is price weighted, meaning stocks with higher share prices have a greater influence on its average as opposed to market cap. So we discussed a little bit about the fact that S&P 500 uses market cap, while Dow Jones uses price weighting. But what market cap means is share price multiplied by the number of shares on the market. And Dow Jones uses price, which is basically what the share price is. So they do have some commonality with share price. It's just with market cap, as far as S&P 500 and Nasdaq, how they make their determination is that the number of shares on the market are also going to be a factor, whereas the Dow Jones doesn't seem to care about the number of shares. So here's some rules to get into Dow Jones and stay with the Dow Jones. So the companies are selected by a committee for reputation and growth. So there's no strict rules, quite like they do in the S&P 500. Like one example is the market cap. Having 20.5 billion in market cap is not needed for the Dow Jones. But one of the more difficult parts of getting into the Dow Jones is you need to be considered a blue chip company, and that means that you're a large company, been established for some time, and you also pay a dividend. And we haven't really gotten into dividends too much, but essentially you can think of it as like profit sharing, sort of. It's essentially a percentage of your shares of stock will also start paying out every quarter some money back to you. So that's what a dividend is. And it's a nice way for maybe even retirees to have money in their pockets, that they need to live. And so some people want that too, even if they're accumulating wealth and not retired yet. So Dow Jones gives you that kind of stability as one way to look at it. And another rule of the Dow Jones is there's specific removal triggers. And one example is a company will be removed from the Dow Jones if, say, it eliminates its dividends, because that's one of the requirements. So here's the Dow Jones company list. Since there's 30 of them, I can fit them on a screen. And as you can see, they tend to have a greater weighting percentage versus S&P 500, which makes sense in that case because 30 companies instead of 500. 30 companies are going to have a lot more weight to them. So the first item is Goldman Sachs, and then you have Caterpillar, then Microsoft, American Express, Home Depot, and so on down the list. I was also going to point out too that you can see NVIDIA on this list as well. It doesn't have as high of a rating because again, NVIDIA is number one for the S&P 500 because that's based on market cap, whereas this is based on price. And generally your price will continue going up more over time, which I think is why the Dow Jones bases it on price weight. It's because they've been established for some time. And usually the price will go up and up and up over time, assuming that there's going to be stock splits here and there that will make the price go back down, but then usually then it'll go back up in price again. So NVIDIA just hasn't had maybe enough time yet, but maybe eventually they'll climb up the list and have a high price to get number one on the Dow Jones list. All right, now we're going to go into the NASDAQ composite. So NASDAQ originated in 1971 as the world's first electronic stock market and was created by the National Association of Security Dealers, NASD. And then you can maybe see where this is going. All we need to do is add the AQ to get NASDAQ to the NASD. So NASDAQ is an acronym for National Association of Security Dealers, Automated Quotations. So its founding purpose was to modernize the market by providing an automated, transparent system for price quotations, replacing the traditional, less efficient manual processes involving phones and physical trading floors. And you might recall from our first lesson that I showed what a ticker machine looked like. So basically everything was running that way for some time, really until the NASDAQ came into being in 1971 and started using our digital world as kind of like we know today. So the majority of companies are U.S. technology companies that are in the NASDAQ. It officially states that it lists over 3,000 companies, but there's other claims that it lists are greater than 5,000. And for the game purposes, I'm going with the greater than 5,000 companies in the NASDAQ. So here are some rules to get in and stay in the NASDAQ. So a company must meet one standard from income, cash flow, market cap, or assets and equity. So meaning it needs to show positive income and cash flow. Also market cap, kind of like the S&P 500 at that 20.5 billion. They have a requirement that'll be somewhat similar. It also must have a minimum number of publicly held shares and shareholders, and a minimum bid price of at least $4 per share for most new listings. And it's something I'll probably dive in a little later in other lessons when we discuss share price. You want to be careful that share prices are not low, like below the $4, for example, because they tend to be not reputable companies sometimes, or they might have taken a hit. And they sometimes are referred to as penny stocks. So it's something that we can explore later. I like to cover that. But I think when NASDAQ has this requirement, it's making sure that the companies are reputable and they're profitable. And usually the share price, you should reflect that. They shouldn't be less than really $5 a share. But they have a requirement of at least having 4 per share. And it must also have a majority independent board of directors, audit committee, compensation committee, and a code of conduct. Essentially, it needs to be a corporation. And here's a list of NASDAQ companies, a partial list, especially if there's thousands of these. But you'll notice here that they're very similar to the S&P 500. You have NVIDIA, Apple, Microsoft, and Amazon. And also we go back to our Google or Alphabet, Class A, Class C shares, and then Broadcom in the middle. And then you have Meta, also known as Facebook, that people might know them. So as you go through the list, you'll see many companies people are familiar with. I'd also point out too, you have things like Costco. Over here you have Pepsi. Those are not technology companies. But for the most part, when you go through the list, you'll see that many are tech companies, as the Nasdaq claims to be mostly made up of, but there are some, just for your information, that are not tech companies.